Okay, viewers, shifting focus then, let's get in touch with the management of Allied Blenders. And this company also joining us on the back of their earnings, just taking a look at what these numbers are looking like. And it's overall looking like a good set of numbers because the net sales are up 9%, EBITDA is up 24%. The net profit is under pressure at 37 crores compared to 79 crores, while margins have managed to expand 200 bips to 16.8%. The overall volume growth at 8.7% on a year-on-year basis also looking good. But let's understand what has caused this pressure on the bottom line because PAT has seen significant contraction. On that note, let's welcome on board Mr. Alok Gupta, the MD at Allied Blenders and Distillers, joining us on the show. Mr. Gupta, morning and thanks so much for your time. I was just taking a look at your numbers right now, and the net profit has come under pressure this time around, while the other three metrics continue to do well. Can you help us understand what has caused this pressure on the bottom line for you this time?
It's just a one-off entry that we had to take in Q4.
Right.
If you were to take the one-off entry out, the PAT growth would have been about 35%. And having taken this one-off hit in Q4 from next financial year, we will see that the PAT is back on track. So it's just a one-off effect.
Thanks for that perspective. And let's talk about your net sales. That was up 9% year on year, led by strong growth in the P&A category. How much of this is sustainable? Can we expect to see this 9% number continuing ahead?
9% is our volume growth, which is overall growth. P&A growth is roughly 25%. And our guidance for the next couple of years is that P&A will continue to grow at mid double digits. And we believe we are on track as far as the P&A portfolio is concerned. Our luxury portfolio has started to do well, and therefore we expect that the volume from the P&A will grow significantly higher. Just to give you two numbers, we get roughly 47% of our volume from P&A, but about 55% are value from P&A. Over 2 years, we expect volume share to be more than 50%, but value share to be between 65 and 70%.
Okay, so that double-digit volume growth guidance for the P&A segment, is that something that you're going to continue to maintain?
Yes, we are confident that we'll be able to deliver mid double-digit growth on the P&A segment.
Okay, understood. And you've also expanded your international presence from 23 countries at the end of FY25 to 36 now. What are your plans here? Which geographies are looking the most promising?
We've broken the international market into three kinds. A strong legacy market, which is the GCC. Over the last few quarters, a lot of focus has been put into Africa, which has started to now paying dividends. We are also looking at the Western markets, looking at establishing a hub in Europe that will give us access to the European market. The FTAs are all getting into place. So we believe that over the next 2 or 3 years, we should be able to accelerate our value growth in the international revenue, which has been going consistently at about 16-17% year on year.
And since you've also spoke about GCC, I just wanted to get a better understanding on, have you been seeing any impact of the West Asia crisis on export demand? Any hit seen over there?
The challenge that we faced is on the shipping side because some of the containers could not move. But we believe that from this month onwards, shipping at least into the GCC is back on track and the demand is coming back. We do not see any loss of eventual consumer demand because our distributors tend to carry between 2 to 3 months of stock. So we are well in the position to make sure that the consumer demand is serviced. And by end of this quarter, we should be able to refill the pipeline.
Okay, so that sounds good as well. And Mr. Gupta, you've raised your FY28 target for gross margins and EBITDA margins from 17% earlier to 18% now. What has made you hike this guidance? Anything that you can help us understand on this front, on the margin front?
Well, certainly, I think we've had 4 key levers as far as margin expansion is concerned. We've already covered one, which is the P&A. P&A value share to go from 55% to 65% plus. That will help us in terms of our gross margin improvement. Our investment in CapEx program by FY28 will add about 300 basis points to our margins. And the India-UK FTA, since we are the largest importer of Scotch in India, should add another 200 basis points. So combination of these 3 critical initiatives, which is continuous momentum on P&A, CapEx investment, and the FTA, will help us to get to the targeted margin. That's the reason we have revised our EBITDA guidelines by another 100 basis points upwards.
Okay, Understood. So that also sounds good. Mr. Gupta, let's talk about your state-wise outlook. What's your outlook on Maharashtra post the MML impact in terms of P&A and regular volumes for FY27? Along with that, the Karnataka excise policy change that we've seen, any impact on the business from this so far?
As far as Maharashtra is concerned, I think now we are seeing both mass premium and P&A volumes have sort of become more predictable in nature. You're aware that we have now been allowed to at least participate in MML. We have already put in our application with a few brands that we expect to participate with MML. Therefore, once these applications get cleared and we are allowed to participate, my sense is that we should see significant growth coming back in Maharashtra. Karnataka is still very early days. If the policy is implemented in the manner that is envisaged, we should definitely see an upside on P&A. Iconic is already doing extremely well in Karnataka, and we should see some sort of a hockey stick growth coming on the brand.
Okay, so that sounds good as well. And Mr. Gupta, with changing consumer preferences and the rise of craft spirits in new categories, how are you thinking about innovation across RTDs or tequila or any of your craft spirits? And help us understand if there are any new exciting launches, any new products that are in the pipeline?
I think there are two different craft. One is RTD, which is sort of spontaneous consumption, which is more casual. We have evaluated that space. We believe we have limited synergy in that space. So for now, we have parked it on the side. The second and the more attractive side is the spirits craft space, whether it be gin, whether it be tequila, whether it be craft Indian whiskeys. We have built a portfolio of 10 brands. If you would recall, when we were getting into our IPO, we had zero presence. Now we have vodka, we have gin, we have rum, we have a blended malt, we have an Irish whiskey, and of course an Indian whiskey. This segment is roughly 3% by volume, but 20% of industry profit. Now that we've built out our portfolio and made our presence felt, distribution in domestic market, we opened up travel, retail, and also international market. We should see this year is going to be an important year in terms of revenue growth.
Okay, sounds good, and good to be chatting with you ahead of the weekend, Mr. Gupta, and wishing you a very happy weekend, and thank you so much for your time.
Thank you so much. Appreciate your time.
Thank you.